one of the interesting ones was like in tech when, Google came out and they put out their
Mm,
earnings, just sort of
right,
playing into that theme. Like they looked really good. Just if you didn't consider like the expectations that were set for them, like I think they beat
right. Yeah,
revenue and earnings, but then their YouTube ad revenue came in below estimates and it just got crushed and it took down
right,
so much of
right.
tech. And the market just wanted like, I think part of it is also like AI spend. The market's starting to actually want to see, okay, like you're putting billions of dollars into AI and developing these platforms, but they want to see, some sort of product or some sort of return on all this money that's being put in. So
One,
I
two,
think,
three, four.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 7th episode of The Exponent with 5i Research. My name is Chris. I'm a senior investment analyst with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. Today, I'm joined by my co-host, Zach. Welcome, Zach.
hey, thanks for having me back.
Yeah, always great to have you here, and always a good chat when we're talking markets, talking Canadian small caps. We've got a big episode today, a lot to talk about. The markets have been moving even during the summer months when markets are usually fairly tame. But we've got a lot of things going on, like the Bank of Canada has been cutting rates. Soft inflation data has been coming out of the US. We have a bit of a shakeup in the markets between small caps and some of the mega cap tech names, some of these AI plays, bit of a rotation going on there. And that's kind of been like a buzzword over the last week or so. So what are your overall thoughts and like how are you feeling about the markets right now?
Yeah, it's interesting. Small caps are back. That I think it was like after the inflation data when it came back pretty low, I think, to expectations or
Yeah.
in line with expectations. But looked good, and the Russell just jumped. I think it was, what was it, 4% in the one day.
Yeah.
So
Yeah.
yeah, pretty
That was a
impressive
huge
moves
move.
there. Yeah.
Yeah, definitely. For anyone that's, still like glued to their screens, even in the summer months on vacation, like some of these moves are pretty unprecedented, and it's pretty wild to see just some of the whether it's short position covering or just large buys coming in from the sidelines. Anything like that is really just like moving some of these smaller names, and it's been really cool to see that finally kind of take place after what was like mainly a trade dominated by like mega caps and large names. So yeah, always good to see
Yeah,
some healthy
totally.
rotation.
Yeah, that shift from mega caps was crazy because they just had been like
Yeah,
nonstop run up, and I don't think people expected them to drop the way they have like over the last
right.
month or so, just constantly.
Yeah, and so we've got a big lineup today. We've got quite the packed agenda. So, first thing we're going to be talking about is Canadian small cap names. Then I'm going to be talking about a research piece that I've done on small caps. Zach's going to be going through some base hits from 5i. Next, we're going to be looking at what we're seeing in the second quarter earnings so far and what we're kind of anticipating coming up. And then lastly, we're going to be going over meme of the month. So that's kind of like a new segment that we're going to be trying out here. So with that said, the first one, Canadian small cap names. Zach, do you have a small cap name that you want to talk about today?
I do. So I wanted to talk about Kraken Robotics. Ticker there is PNG.B. So pretty much what they do is they're a marine technology company, and they provide ultra high resolution sensors, power systems, and underwater robotic systems. They supply advanced sonar and optical sensors, batteries, and underwater robotics equipment. That's for unmanned underwater vehicles, which is used in military and commercial applications. So I think we've seen some pretty nice like increased military spending there, and that's part of the reason why we have that nice run up in the stock price. PMG specifically is recognized as one of the world's leading innovators of synthetic aperture sonar. SAS is the acronym there. It's a disruptive underwater imaging technology, and so they actually have like an advantage with some unique technology that is pretty well recognized. And the company's just overall goal is to become the leader in both underwater equipment and services. They operate through two segments right now, which is products. So they actually sell those individual like underwater related like sonars, batteries, things like that. But then they also have a services segment. So they made an acquisition back in 2021 and it was rebranded to Kraken Robotics in 2023. And pretty much what the robotic services segment does is working with those high resolution 3D acoustic imaging solutions for the subsea bed. And they kind of coined the term RAS, which is like play on SaaS. So it's robotics as a service, which is what they're selling through their services segment. So pretty interesting there. And I think with some of the like military spending, it's made them have that pickup in demand. We can just look at the next slide here. We got like the fundamentals, and we can see like things have been looking pretty nice for Kraken. So revenue growth is, of course, very high recently, and profitability is also rapidly expanding. They became profitable over the last few quarters, and they also, have no debt, which is a big positive for them. And part of, the big share price run up that they've had recently is because they've been picking up some big name contracts, from the US Navy. And I think that's been a pretty big catalyst. So if they can continue to get some of those, big name US Navy contracts, things could look pretty good. And so it is like a very small cap name. It's, just under 300 million in market cap, but fundamentals honestly look great right now. And it trades at about like 19 times forward earnings. So not too expensive, but for the growth it's seen, I think it's reasonable.
Nice. Yeah, that's great. Yeah, I like the price momentum that it's seen is great. But also looking at these stats here, it's really interesting to see like, for viewers that can see this chart, the very bottom panel, we have like EBIT margin, and it looks like it's flipped positive just over the last year. And even though it's it looks like a very small bar, it's still a 14% EBIT margin. And it's looks like it's one of the first times it's gone positive in the past, at least decades. So that's really encouraging to see that, just a profitability level from a small cap like that name. And also just like the revenue growth trend and consistent gross profit margin. So all three of those factors kind of really, give this name a pretty strong lift here. And you and I were talking about this name a little bit the other day, and we were talking about how like this is, one of the few defense names in Canada. So there's a few others, of course, that trade on the TSX, but it's really cool to see that sort of niche within the Canadian market, and also one that's, seeing like really positive catalysts and some tailwinds here.
Yeah, no, totally. And just to the point of like them being in that small niche, I think like in that like military defense area, there's been a lot of, and like a big theme kind of similar to healthcare, is the bigger players acquiring some of the smaller ones. So I think being a Canadian name, this was just like a personal take that I think they do have some of that potential with, being recently profitable and not having a lot of debt to potentially be an acquisition target there. But standalone basis, it looks great as well.
Yeah, nice. Yeah, and it's like we're seeing that a lot in the markets where Canadian companies are just being scooped up and taken private, like left, right, and center right now. So, yeah, so an acquisition's totally within the realm of possibility at, especially at a $300 million kind of level. So,
what's your small cap name?
My small cap name is Trisura Group. The ticker is TSU. So Trisura, of course, I love my financial name. So Trisura is a small insurance company. So it's a small $2 billion company, initially spun out from Brookfield Asset Management in 2017. And it's an international specialty lines insurance company. And it's seeing lots of growth opportunities within both its Canadian operations and, expanding on its US side of things. And so being a specialty lines insurance company, its insurance policy premiums are a lot more, they have better margins than what you would see in the P&C, like property and casualty side. So that's kind of what I like about Trisura, is that, when things are going well and it's not seeing many claims, it's going to be like quite profitable At least that's what I've seen in the past, and that's what I believe could happen with Trisura. And then, price wise, it's been consolidating for the past few years. And a lot of this kind of consolidation, like sideways price action, it's been due to mainly some write-offs and recoverables that it experienced with another company. So these write-offs really impacted earnings for about a year. And now it looks like we're seeing some of these issues be resolved and in the rearview mirror. And in its recent results for Q1, it reported a 15% ROE, or return on equity. It's seeing a return to growth. Insurance revenue is growing at about 17%, which is fairly strong and quite good for a high margin, sort of stable finance kind of business. And it's fairly cheap as well. So it's trading at about a 15, 16 times forward earnings. And I've pulled up this chart here, and we can see, the top panel is looking at return on equity. Middle is looking at some of these profitability levels like EBITDA, EBIT, net income. And then the bottom is cash flow from operations and free cash flow. And kind of what I wanted to point out on this graph is we saw all of those metrics really dip into 2023 and then recover coming out of 2023 and into 2024. And a lot of that's due to those write-offs from the reinsurance recoverables. And so now we're seeing this drastic kind of return to high levels of profitability. And I think that, if we continue to see top line growth expand, and if it can continue to win market share in the US and in Canada for specialty lines, I think that trading at 16 times forward earnings could be considered cheap if it continues to see like high revenue growth and other things like that.
Yeah. Yeah, no, it looks like a great name. That that profitability story really looks like pretty nice. If you go back to the start of 2023, end of 2022, it's just nice, clean upwards. And I think something that's interesting is the cash from operations and the free cash flow. It looks like they have a super high margin on their free cash flows, which is always a good thing. And just sort of to that insurance, a bit more of like a capital lighter business model, which is nice.
Moving on to the next piece here. So, given the whole rotation that we've seen from small caps and just kind of this like explosion, I conducted a research piece on small caps, and I wanted to talk about some of the findings that I have here. One of the biggest events in the market over the past couple of weeks has really been this massive move that we saw in small cap stocks, particularly the Russell 2000 index. So, a few weeks ago in early to mid-July, the US inflation reading came out softer than expected, and the markets rallied. And it was wild. I think, the Russell 2000 was up about 3.5% on the day. And on that day, we saw this wide divergence between small and large cap stocks, mostly as, traders were basically pricing in higher odds for a rate cut, which will, benefit small caps more than it would large caps, just due to funding and their financing and things like that. And so I've done some research on this small cap rally, and one little stat that I found really interesting is, on that day we saw the Russell 2000 move up about 3.5% in a single day, and that's a entire index. So that's a really big move just for 2000 stocks combined. And so that sort of daily gain of 3.5% or more actually only happens 1% of the time since the late 1980s. So a really rare occurrence. And typically when it's happened in the past, on average, the forward returns are quite strong. So history is kind of on our side for that one. But in this chart, for viewers of the podcast, what I'm showing is in the top panel in the gray area graph, that's looking at the relative performance of the small cap space versus large caps. So it's basically Russell 2000 against the S&P 500. And what I found really interesting, and I think it's indicative of what we can see next, is we've seen mostly this kind of relative performance be mostly flat, but with periods of outperformance and underperformance. And then, in the bottom panel, we're looking at the daily gain or loss for that relative performance. So how much is the Russell 2000 outperforming the S&P 500 on each day or underperforming? So when we got that weak CPI print, we saw the Russell 2000 outperform the S&P 500 by more than 3.5%. It was a 4% relative outperformance kind of day. And I looked back across history since the late 1980s and analyzed how many times that sort of move, that relative outperformance has taken place. And it's only taken place 6 other times in the last 35 years. So again, like a really rare occurrence. The first 3 took place in 1987 and 1988. The other 3 have taken place since 1989 to basically today. And so then what I did is, after looking at, how often these sorts of moves happen, I overlaid all of those instances on the Russell 2000 chart since the late 1980s. So in the orange dots, those are each instance where the Russell 2000 outperformed the S&P 500 by more than 3.5%. And just kind of visually, we can see that those were, historically pretty good buying opportunities. We can see like near 2008 and 2009 kind of bottom, 2011 market bottom, pretty much the bottom of March 2020. In the early, in the 1987 and 1988 period, which was also close to a market bottom. And then most recently in July 2024. So kind of a really like striking visual chart I found. And then after looking at, how it looks visually on a chart, I analyzed the data on a table and looked at different forward return metrics. So what's the forward 6-month, 1 year, 2 year, and 3 year returns each time that happened across history. And, there's really 2 instances where the forward returns were negative. Every other return across history was positive, and the average returns are pretty phenomenal. The forward 6-month return for the Russell 2000 historically was 19% on average. And that's just a 6-month forward return. Like, that's a really short time frame. Forward 1 year return was about 37% on average. Some of that's being skewed higher from the pandemic, kind of the March 2020 lows. But aside from that, we saw 11%, 24%, 20%, like really strong numbers. And so I think that while we can't, say for sure that that's what's going to happen this time, I think the odds and the probabilities are really on our side. And these sorts of moves, when they do happen, I think it's kind of like a flashing signal. This is like, a telltale sign that, I think positive things are coming. And the history shows that, on average, the forward returns are quite strong. And so that's kind of my thesis for why small caps can really outperform over the next 6 to 12 months.
Nice. Yeah, it's pretty hard to deny small caps there. And like, just the way those returns look and everything, like, it's hard to not want to be invested in them right now. Seeing that, it's definitely impressive. And I think we've sort of talked about it at Five Eye. Like, people have asked us, what's it going to take for small caps to be better? And I feel like we've been saying like probably rates. And then like after that recent indication that like rates are going to get cut soon, we had that big move. So that was sort of like a nice telling sign there. But yeah, it's pretty hard to not like want to be in the small caps now seeing this, I think.
Yeah, definitely. It's I think, for a lot, it's been kind of a frustrating trade with the small caps, because like literally every other index out there, some parts of Europe, the TSX, the Dow Jones, NASDAQ, you name it, they've all hit all-time highs. Really, one of the only ones that hasn't has been the Russell 2K. Next segment, we've got a new one from Zach. So it's called Base Hits from Five Eye. So Zach, why don't you tell us about what's going on in this segment here?
Yeah, for sure. So I'll just explain like what a base hit is. So it's pretty much just a term that we use for stocks that we think someone can just purchase and hold and just not really worry about it quarter to quarter. So it's sort of like a set it and forget it type of mindset and investment where, you buy it and then you don't have to sweat like, oh, like did they meet or miss earnings this quarter? You can just buy it, look back on it in like a year, 3 years, 5 years, and you should have some pretty good returns that ended up being decently low risk. So just, a nice, easy base hit there. And three names that we sort of came up with in the Canadian space that we feel fall into this category really nicely are Constellation Software, CSU, Brookfield, and ATD, which is Couche-Tard. So uh, the thing with these three businesses is that they're totally different. Like CSU, they're in the software space. They build, acquire, and manage vertical market software, and they have that super like acquisitive focus in their growth strategy. Brookfield, they're focused more on alternative investments and real estate investment management. And then ATD, they operate and license convenience stores. So from a business model perspective, when you're looking for a base hit, you may not specifically be looking for like a specific industry, but what you would be looking for is more so how the business is run and how they've been able to grow. So all the companies that we listed, the thing with them is that they have long track records of sustainable growth, being able to execute on their strategies, and well experienced management teams. So that's more so what we look for in those sort of base hits. And the other aspect of that is that they're also very large companies that are market leaders in their respective industries, which is another important characteristic. Like these aren't small cap names, they're larger cap names, and that sort of reduces some of the risk, and it shows that these are leaders in their space and there's not less competition concerns of a bigger player coming in and stealing market share from them. So just with the charts that we've got here, just to show like the compounding nature of them, we can see that it's the price chart, and then in that top panel, the 10-year return CAGR. So that's of course come down for CSU over time, just as the prices continue to go up. But the return CAGR is still at 35% over the last 10 years. So it's been super nice and steady there. And we can see just like the way the revenues and EBITDA have been able to grow as well, just sort of showing that, the growth trends have been there. And it's just a simple way to show their market leadership and ability to execute. So looking at Brookfield Corporation as well, similar trend, a bit just like choppier, but Brookfield, been able to grow pretty sustainably over the long term. And if you look back from like 2015, if you were to have gotten to Brookfield then, you would have been doing very good, to say the least. And similarly, looking at like revenues and EBITDA, just that long-term trend of nice upwards and being able to display consistent growth and management execution is really important. And then ATD is the last one here. If we look at these price charts, just like what's in common, they're just nice, steady upward, not too much, big drawdowns or anything, which is a big part of having that lower risk. And obviously, that's hard to predict in the future, but having like a 10-year history of being able to produce those sort of returns and that sort of upward price movement, it definitely bodes well for the future. And it shows that these companies have that leadership in their space. So that's just sort of the base hits sort of aspect that we were looking at. And looking at the US side, we didn't prepare any charts really, but we think if you look to those like Mag 7 types of stocks and like a Google or an Amazon, where they're just so significantly the leader, they have so many different types of services embedded in their business. That's a good way to sort of play that base hits theme there.
Yeah, no, I love that. Yeah, it's great. I love like these base hits sort of names because it's names that investors can have. If an investor can develop conviction in some of these names, and if one can feel confident in their track records and their management teams, these are names that kind of allow investors to sleep at night. And I think that's like so critical when when the market's moving higher, it's easy to go out the risk curve and start to like buy some smaller cap names and things like that. But when we have events like 2022 or 2020 where things get a little hairy and like drawdowns are huge, having a high conviction name that one can feel comfortable with no matter what, like thick and thin, is, in my opinion, like super critical to one's portfolio construction. So yeah, I think these are all great names, and I totally agree with kind of the thesis on that. So yeah,
and just connecting it sort of to like the small caps that we were talking about before and how there was that big pop. I think like having a combination of both is important, but when you pick one of these
Mhm.
sort of like base hit type of stocks, it's much easier. You don't need to worry about it as much. So there is like, yeah, small caps have been doing great recently, but you also need to think about how much easier it is to have like these type of base hits.
These are extremely strong names that investors historically wouldn't have been disappointed in owning. That's for sure. So yeah, awesome. No, I love that. Cool. And then next segment we're going into is kind of what we're seeing in the second quarter earnings so far for this year. And so we're right in the thick of earnings season. A lot of U.S. names are starting to report. The Canadian side of things is slowly kind of coming into play here. And so, Zach, I think you were going to talk about some of the trends that we're seeing in earnings so far. Kind of, what's your take on earnings season so far? I guess.
Yeah. So I think so far, we've seen some pretty sharp reactions and maybe a little bit more weakness, but just in terms of like the sharp reactions, it feels like similar to last quarter, like, if it's not a beat and a raise in most cases, the stock ends up being down. Just
Mm,
like a little bit of like the industries. I looked at like financials, automobiles, and tech, and I think financials was interesting, especially on the US side, because they had pretty good beats on earnings and revenue, and investment banking demand had been coming up, which is a pretty good indicator that like the capital markets are strong and becoming stronger. So that was a positive on the financial side. But one thing that the banks did notice, and especially there, was that there's some softness from like the low income consumers, and Citigroup specifically. They saw a 74% decline in their credit card and consumer banking business segment. So that could be
well,
a bit, company specific, but it also does just highlight how, with high rates, high inflation, and then now starting to be a bit weaker of a job market, it has to pressure some part of that economy. And I think the lower income side's getting a bit more pressure there. So while the financials results came in pretty decently, there is, it shows some broader weakness in the whole economy, which I thought was interesting.
interesting. Nice. Yeah, that's a good take from that. I like that. It's interesting because it does feel like this is where stock market investing is complicated, because on the one hand, some of those results kind of indicate that inflation's slowing. Consumers are feeling the pinch, which is a positive for the inflation side of things, but obviously not great for overall economic growth. And so how do you kind of marry those two concepts? And that's kind of where the markets get interesting, is where is good news, or is good news bad news, and vice versa. So all of that is kind of the situation we're in now. So really interesting to see those results. And like you were saying on those big drops, yeah, some of these drops have been quite precipitous. So it's not uncommon to see like a 10% daily decline if a company doesn't raise guidance or something. So
I think the one of the interesting ones was like in tech when, Google came out and they put out their
mm,
earnings, just sort of
right,
playing into that theme. Like they looked really good. Just if you didn't consider like the expectations that were set for them, like I think they beat
right, yeah,
revenue and earnings, but then their YouTube ad revenue came in below estimates and it just got crushed and it took down
right,
so much of
right,
tech. And the market just wanted like, I think part of it is also like AI spend. The market's starting to actually want to see, okay, like you're putting billions of dollars into AI and developing these platforms, but they want to see, some sort of product or some sort of return on all this money that's being put in. So I think that's just another point like to watch out for in tech going forward this earnings season. That could be a theme where if companies don't like have some sort of product or some sort of returns to show for all that AI spend, then not to say like the theme's going away at all. It's definitely like
yeah.
strong still, but I think the companies and the investors want to see a little bit more in terms of like actual tangible results there.
In the US markets, so yeah, this week is by the time we post this podcast, a lot of these names will have likely reported, but we have Microsoft, Meta, all of these mega cap tech names reporting coming up. So the market's really waiting and anticipating some of those names. A whole mix of discretionary, healthcare, industrial names. And, personally, I think some interesting areas to watch will be looking at utilities, which have been so beaten down over the past year with high rates and their high debt levels. So any sort of like good news or guidance or outlook from these companies, I think can really help support their prices. And then I also think healthcare is a really interesting space. Just because that's an area that historically has really done well on a price like risk adjusted kind of return basis, and their earnings are usually quite stable and healthy and things like that. But over the past couple years, we've kind of seen healthcare like just kind of go sideways and just kind of trade flat for a bit. But recently we saw, United Health Group, J&J, some of those names kind of popped after good earnings. So I think that could be some sort of, beginning of the healthcare sector potentially performing well here. And then on the Canadian side of things, we have a lot of names reporting this week, but a lot of them coming into the middle of August. And personally, I think BCE and TELUS will be really interesting to see the results from those, just because they've been so depressed price-wise and everything, and sentiment-wise over the past little while. High debt levels, worries over the sustainability of their dividends and things like that. And so I think those will be really interesting to watch the results from. And then also we have Constellation Software earnings coming out, and that's always a fun one to watch. We have one last segment here. It's called Meme of the Month. So Zach and I are going to share like a meme that we found relating to the stock market during the month. So here's the meme. And for listeners of the podcast that can't see the meme, basically this is a meme from the show Community. And, the picture is like a guy walking in with pizza boxes into an apartment room, expecting a party, and he's got the letters IWM over his face for small caps. And so he's, walking into this room expecting a party, and basically like the room's on fire. There's people in there trying to like frantically put out this fire, and they've got like fire extinguishers and stuff. And the people putting out the fire is supposed to be, tech stocks, AI stocks, all of these like well-performing names over the past year that are now, kind of, I guess, supposedly ruining the party for small caps. So kind of like a good depiction of what's been going on in the market the past couple of weeks. Small caps finally like joining the party, and then the party's just getting like pretty much crushed by some of these AI names. So
Yeah,
what are your thoughts here,
one.
Zach? Yeah.
It's a funny one. I feel like it's been the total opposite just for like the longest time. So
Right.
maybe,
Yeah.
maybe it's a little deserved, but
Yeah, fair.
I think Tech has a flamethrower in his hand also. So
Yeah, that's so true. Yeah, fair. Okay, there we go. Yeah,
shows how bad it was for Tech over the last little bit. But
yeah, that's right.
no, it's a good one for sure, and it highlighted that rotation good.
Fair enough. Just like ruining the party for themselves. Yeah, that's a good point. All right. And then, like as an analysis, just kind of like dovetailing off of that. So I pulled up this two tables, and this comes from the sources from Goldman Sachs. And, right around the time that we had that soft CPI report that really sent like small caps higher, someone put out this interesting analysis, which showed what the theme rotation was in that, massive move higher in small caps through the 5 days. So what we really saw was in the year to date preceding that soft CPI, we saw, the AI names doing really well, mega cap tech, Power Up America, which is kind of like energy names. Those were like the best performers year to date. In the 5 days following that soft CPI print, we saw those names become the worst performers in those 5 days. And then conversely, the bottom performers year to date were, we had non-profitable tech, high beta 12-month losers, basically anything that's, high sensitivity to the market, and it's been down over the past 12 months, and also liquid regional banks. So those were the worst performers year to date. They became the best performers over the following 5 days after the CPI print. So really it was like this massive rotation, just complete inverse of what's been happening. And so I thought that was like really interesting and really telling of what happened in those 5 days.
Yeah, totally. And if you look at those like top few that got rotated into like liquid regional banks, housing exposure, non-profitable tech, biotech. Those are some of like the biggest losers from before. So it's great to see
Right.
that
Yeah.
movement happen there.
Yeah. Yeah. No, it was a pretty wild move. So, yeah, kind of just like an interesting thing from a data and market enthusiast kind of perspective, I guess. And then I think Zach, you had something to share as well, so I'm going to bring that up here.
Yeah, just a little bit related to that point. The chart that's on the screen here just shows the performance of the S&P 500, and then the bottom pane of the chart has the relative performance of two ETFs, which is the S&P 500 high beta ETF relative to the S&P 500 low volatility ETF. And what we can see is that high beta has just started to and been pretty consistently outperforming low volatility uh, pretty much since the end of 2023. And I think that just sort of goes into your previous chart there a little bit and builds off of that. We've seen sort of that risk on mindset sort of turning over a little bit where high beta stocks are starting to perform better and people are shifting away from those low volatility, more defensive names. And yeah, investors, this is more for the S&P 500, but I think it all also is like telling of, small caps as well and just general investor sentiment where they're willing to take on a bit more risk. And some of the riskier names are performing a bit better now too.
Yeah. Yeah. No, definitely. The timing and the cyclicality of the general markets and things like that. Like, zooming out, there's all these intra-month, intraday kind of rotations. And what we're seeing here is, really since the bottom of 2022 that, all these high beta names, things that are high growth, highly cyclical, outperforming. And, it doesn't always last forever sort of thing. And that's kind of the natural rhythm of the markets. But certainly, an indicator of the current market we're in for sure. Yeah.
Yeah, definitely.
All right. So that's all for today. We hope that you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.